All right, today we're going to dive into one of the most powerful and, frankly, one of the easiest tools for any Singaporean who wants to build wealth beyond our little red dot. We're talking about exchange-traded funds, or as you know them, ETFs.
But first, I've got a question for you, and I want you to really think about it. Take a quick mental inventory of your finances. Is pretty much all of your wealth tied up right here in Singapore? Look, if the answer is yes, you're not alone. It's super common, but it comes with some hidden risks we really need to talk about.
And that situation leads us right into our first section, what I like to call the common investor's dilemma.
Think about it for a second. For so many of us, our financial world looks something like this: our HDB flat, our CPF account, maybe a few blue-chip Singapore stocks, and of course, the company that pays our salary. Now, these are all great things to have, but the problem is they're all linked to the health of Singapore's economy. This creates what we call concentration risk. You're basically putting all your eggs in one basket, making a huge bet on the future of just one single country.
So what's the fix? How do you break out of that? Well, that brings us right to Section 2. ETFs are, quite simply, the answer.
You see, the old way of doing things was a real headache. You had to research individual companies, try to pick the winners, and avoid the losers, which is, let's be honest, incredibly tough. But the ETF way? It's a total game changer. Instead of buying one company, you buy a whole basket of them, hundreds, sometimes thousands, all in one single easy transaction.
So let's get the official definition down. An exchange-traded fund, or ETF, is basically a fund that owns a whole collection of assets. Could be stocks, bonds, you name it. But here's the magic part. The entire fund trades on a stock exchange just like a single share of, say, Singtel. What that means for you is instant, broad diversification with literally just one clip. Okay, so it sounds simple enough, right? But you might be wondering, what's going on behind the scenes? How does this whole system stay fair and efficient for an investor like you? Well, let's pull back the curtain in Section 3 and see how it all works. And this is a really important question. I mean, if this thing is trading all day long, being bought and sold every second, what stops its price from drifting way off from what the stuff inside it is actually worth?
Well, it turns out the system has its own built-in price police. There are a group of really big financial institutions called authorized participants, or APs for short, and their job is absolutely crucial.
These APs use a process called arbitrage to keep the price honest. It's actually pretty clever. Let's walk through it. So if the ETF's price on the market gets a little too high compared to the real value of its stocks, the APs jump in. They can make a risk-free profit by selling those expensive ETF units and buying the cheaper stocks underneath. And on the flip side, if the ETF's price dips too low, they do the exact opposite. This buying and selling pressure from those sides acts like a rubber band, constantly pulling the ETF's market price right back to its true value.
All right, so you get the mechanics. Now let's get you geared up with the essential concepts you'll need to actually navigate the ETF world. Think of this next section as your ETF toolkit.
First up, you got to know that ETFs aren't all the same. They come in a few different flavors. You've got your equity ETFs, which are baskets of stocks and are perfect for long-term growth. Then there are bond ETFs, which hold debt and can act as a stabilizer in your portfolio. And of course, for all you property fans, there are REIT ETFs, which give you a piece of a whole portfolio of properties, often from all over the world. Okay, this next one is absolutely critical. You have to look for the expense ratio, sometimes called the TER. It's just the annual fee that the ETF manager charges to run the fund. Think of it like a tiny leak in your investment bucket. The rule here is dead simple. The lower, the better, always. Every fraction of a percent you save in fees is more money left in your pocket to grow. And hey, remember how we were talking about the true value of the fund? Well, the official name for that is the net asset value, or NAV. It's the precise, end-of-day calculation of what one share is really worth. And thanks to our friends the APs, the market price you see throughout the day should always be hugging that NAV very, very closely.
Now for a topic that is so important but often overlooked: taxes. Where an ETF is legally based or domiciled can make a huge difference to your returns. The two big players for us are ETFs based in the US and those based in Ireland. Here's the key takeaway. For dividends from US stocks, the US-based ETFs can get hit with a 30% tax. But the Irish ones? They often get a much better deal, paying only 15%. Over decades, that difference is massive. It's why for core global portfolios, so many Singaporeans lean towards the Ireland-domiciled ETFs. Okay, enough theory. Let's get practical. Section 5 is your no-nonsense, step-by-step guide to actually getting started.
And you know what?
The process itself is surprisingly simple. Step 1. You just need to open a brokerage account that can access the right stock exchanges, like the one here in Singapore or in the US or London. Step 2. Put some money in it. Step 3. Search for the ETF you want using its unique ticker symbol, that's like its stock market nickname. And Step 4. Place your order to buy. That's it. You're officially an ETF investor.
But here's the thing. Buying the ETF is just the first step. And this quote, man, it just hits a nail on the head. Your behavior, meaning your ability to stay invested, to keep your costs low, and to not freak out and sell when the market gets shaky, that is every bit as important, maybe even more important than picking the perfect ETF.
So to help you build that discipline, our final section is all about the common traps people fall into and the right mindset for success. Let's talk mistakes and masterstrokes.
Let's kick off with the don'ts. First, a classic mistake, chasing whatever was hot last year. Bad idea. Second, buying a bunch of different tech ETFs without realizing they all own the same 5 stocks. You're not as diversified as you think. Another trap is obsessing over dividends instead of looking at the total return, which includes price growth. And finally, please, don't use some complicated leveraged ETF meant for day traders to try and fund your retirement. Keep it simple.
So here's where we land. The ETF itself, it's a beautifully simple, low-cost, and really powerful tool. It does its job perfectly. But that brings us to the real question, the one you have to ask yourself. The tool is simple, but is your strategy? Thanks for tuning in to this explainer.